Hey everyone, welcome back to Ecliptic Fragments. Today we're going to talk about options. Yeah, I know. Yay, options, right? You should be excited for this video. It's going to give you a chance to go over some information about options that you haven't honed down before. And I'm hoping to give it to you guys quick today, just to not overload ourselves all at once. So let's get into it. An option is a derivative contract, giving you the right to buy, but not the obligation to buy or sell an underlying security at a set price, called the strike price, before a set date known as the expiration. So think of the premium you pay as a movie ticket. You pay upfront for the chance to see the show, but if you don't show, your ticket cost is all you lose. So if it costs you $100 for a movie ticket, that would be insane. But no, if it costs you, let's say $10, right, to go see some Marvel's movie, and you don't go to it, right, your date cancels, etc. The only thing you lose is the $10 and the chance to see the movie, but you're not obligated to anything else. You pay the premium today so you can buy at the strike price later, hoping that the market price soars above it. If it does, you profit. But if it doesn't, your premium vanishes. No one's going to be coming after you like the Italian mob or whatever. You already paid your price at the first purchase. Moving on to put option. A put grants the purchaser the right to sell that underlying asset, that NVIDIA stock, at the strike price, right? So it can serve as a hedge against the underlying asset and can protect you from that price decline. And if the underlying asset remains above the strike price, the contract lapses and you lose only the premium. So you're not able to sell the underlying security at the price you wanted, the strike price at which you bought the put option. And that's the only downside. Similar to the call, now we're noticing similarities here, but the key point here is when you're purchasing an option, you're protected against unlimited loss. Your loss is only up to the premium that you purchased it for. Now, remember, the strike price is the agreed upon price for exercise. And the expiration, that is the last date that you can exercise said contract. After expiration, an unexercised option, if you didn't make any moves and click that exercise button, it's worthless. Now, moving on to our next section here, we have the general key concepts. We're going to have the moneyness. So when you have a call option where the underlying asset price is greater than the strike price, right? So this NVIDIA option, and one key point to note is that typically the denomination for options, so you buy one contract, right? The denomination of shares is 100. So if you buy a call for NVIDIA and you're in the money at expiration and you have exercised it, you're able to buy 100 shares of NVIDIA at the strike price. And for a put, now it's the flip. So for a put, it's when the underlying price of the asset is less than the strike price. So if the NVIDIA strike price that you bought the put for is at 100, and by expiration date it's at 105, or just anything above 100. Thus, anything above 100 would constitute a price for the underlying security where the price is not less than the strike price. So you will not be able to exercise this in the money. Okay, and moving on to at the money. At the money is when the price of the security equals the strike price. So if you bought a put or a call whichever one, and the strike price, let's say, was 70. And when everything's said and done and it's time to exercise and the price of said security is at 70, you're at the money. You are at the money. Moving on, we have out of the money contracts. Out of the money contracts, they just have no intrinsic value. The option is strictly speculative. So if you buy an NVIDIA call for, let's say, 120, and it's NVIDIA's price is at 100, you're out of the money by 20. Now, there's two kinds of options contracts that are going to be important for the exam, and that's going to be the American versus the European style. American options, now these can be exercised anytime up to expiration, meaning that if you're at the money, in the money, and you feel like it's time to get out, you can click that exercise button and exercise your contract. Now this is in contrast with the European options, which can only be exercised at expiration date. And this simplifies the valuation, but reduces the exercise opportunities, reduces your chances to exercise. Now, before I let you guys go, I wanted to give you guys an example. Let's see this in action. So this example has to do with a long call. So we have one contract of XYZ stock. Expiration date is July. It's 50 is the strike price. And our premium is $2, meaning that it cost us $200 to purchase said call. Okay, now suppose you purchase this call for $200 in total. $2 premium times 100 shares. Your break-even point at expiration is $52 because you paid $200 to purchase the contract. So if it expires at $50, that means you lost $200 because you didn't make up that purchase price. Versus if it expires at $52, you get $5,200 back. So you get that $5,000 as well as the extra $200 back, meaning that you have broken even. Okay. If XYZ closes at $55 per share, the call's intrinsic value is going to be $5 per share, or $500 in total. So you can take this intrinsic value and subtract your $200 premium, and that's your profit. You made a $300 profit if XYZ closes at $55 per share. Now, converse this with if XYZ closes below the strike price at $48 per share. The option expires worthless, and your loss is limited to the $200 premium that you paid to purchase it in the first place. Thus, this example here, it illustrates how a long call provides leveraged upside with a capped downside equal to the premium paid. All right, guys. Now, to wrap it all up here, and we will be producing more videos that goes further in depth. Feel free to let me know in the comment section as well, whatever topics, stratos, etc., that you guys feel you want to hone down on and you need me to focus on for these sorts of videos. But to summarize what we talked about today, we talked a bit about the options granting us rights without requiring obligations. And the premium equals the maximum loss with respect to purchasing options. We didn't get too deep into selling options, but there's going to be more videos on that as well. This was meant to be short, but I feel like we already went over the 10-minute mark. All right, let's continue. We also talked a bit about the American versus the European style. And to summarize that, the American style options, you can exercise that just whenever up to the expiration date. However, the European style, they're more restrictive with when you can exercise said option. And that time, the only time you can exercise the European option contract is at expiration date. Awesome. Okay, guys. Understanding these fundamentals are going to equip you to handle the Series 7 option questions with confidence. If this was helpful, just please leave a like, subscribe, And let me know in the comments which topics you'd like to hear about next. Thanks for watching.